Have you ever wondered how to grow your money without taking huge risks? We all know that investing can feel like a roller coaster. But what if I told you that there are smarter, safer ways to build your wealth that don't involve risking at all? What if you could grow your money while staying comfortably in your financial lane? In today's video, we're diving into the top 8 ways to grow your money without taking big risks. These strategies focus on security, stability, and steady growth, allowing you to build wealth without constantly worrying about market volatility. Let's dive into these smart, risk-averse strategies that can help you grow your money with confidence. 1. High-yield savings accounts, HYSA. First on the list is one of the safest and easiest ways to grow your money. High-yield savings accounts, HYSA. These accounts are incredibly low risk because they are FDIC insured, meaning your money is protected up to $250,000 per institution. You can find HYSAs that offer interest rates ranging from 4.00% to 5.00% APY, which is significantly higher than traditional savings accounts. While the rate is lower than what you might expect from riskier investments, the peace of mind you get from knowing your funds are secure and liquid is invaluable. Moreover, online-only banks, such as Vio Bank or Lending Club, often offer more competitive rates compared to traditional brick-and-mortar banks. If you're looking for a place to park your cash temporarily while earning interest, this is a reliable option that gives you both safety and growth. 2. Certificates of deposit, CDs. Next, let's talk about certificates of deposit, CDs. CDs are an excellent choice for conservative growth because they offer guaranteed returns and principal protection through FDIC insurance. When you invest in a CD, you lock your money into the account for a fixed term, which could range from a few months to several years. With rates projected to drop further, locking in a 4.00% plus APY on a 1-year or 5-year term is a strategic move to beat inflation. One clever way to manage CDs is by creating a CD ladder, where you stagger the maturity dates of your CDs, allowing you to maintain regular liquidity while still earning a competitive return. Instead of locking all your money into one long-term CD, you could put some into shorter-term CDs and some into longer-term ones. This strategy allows you to access your money at regular intervals while still benefiting from higher interest rates. 3. Treasury securities, T-bills, and TIPS. Treasury securities, including T-bills, Treasury bills, and TIPS, Treasury inflation-protected securities, are some of the safest investments you can make, backed by the full faith and credit of the U.S. government. These securities are often considered one of the safest investments globally. Treasury bills are short-term debt instruments that range from 4 weeks to 1 year, and their yields have recently been between 3.66% to 4.9%. TIPS, on the other hand, adjust their principal value based on inflation. This ensures that the purchasing power of your investment does not erode over time. If inflation is on your mind, TIPS are the perfect investment vehicle to maintain the value of your money over time. You can purchase T-bills and TIPS directly through Treasury Direct or through a brokerage account, giving you flexibility in how you invest. 4. Money market funds. Moving on to money market funds. These mutual funds invest in high-quality, short-term debt and are designed to maintain a stable net asset value, NAV, of $1. They offer slightly higher yields than traditional savings accounts while providing more liquidity than CDs. While money market funds are not FDIC insured like savings accounts or CDs, they are highly managed for extreme stability. The beauty of money market funds lies in their balance between yield and liquidity. They are especially attractive for short-term investments because you can access your money whenever you need it without worrying about market volatility. These funds invest in things like short-term Treasury bills, commercial paper, and repurchase agreements, which are all considered very low risk. However, while they provide a safe place to park your cash, the yields tend to be lower than what you get with riskier assets like stocks or real estate. But for those who prioritize security and want to avoid market fluctuations, money market funds provide a reliable and stable option. 5. Dividend-paying stocks. Now, let's explore dividend-paying stocks, a slightly higher risk, but still relatively safe way to grow your money over time. By investing in dividend aristocrats, companies that have consistently paid and increased their dividends for years, you can earn a steady income stream while still holding an equity stake in the company. These stocks tend to be less volatile, especially in sectors like utilities, healthcare, and consumer goods. The beauty of dividend-paying stocks lies in their stability and the passive income they generate. Even during market downturns, these companies continue to pay out dividends, offering you a reliable source of income. Moreover, reinvesting your dividends can significantly accelerate your wealth through compounding. Instead of cashing out your dividends, use them to buy more shares, which will then pay dividends, creating a cycle that leads to faster wealth accumulation. While dividend stocks come with more risk than bonds or savings accounts, they still offer a relatively safe way to grow your wealth. By focusing on companies with strong fundamentals and consistent dividend histories, you can build a well-balanced portfolio that generates income while growing over time. 6. Low-cost index funds. Another great way to grow your money without taking on too much risk is through low-cost index funds. Rather than trying to pick individual stocks, index funds allow you to track broad market benchmarks like the S&P 500, which includes 500 of the largest companies in the U.S. This strategy gives you instant diversification, which reduces the risk of having all your money tied up in one company or sector. Low-cost index funds are an excellent choice because they typically have very low management fees, expense ratios, meaning more of your money stays invested and continues to grow. By spreading your investment across hundreds of companies, you reduce the risk associated with any one company failing. Additionally, over the long term, the market tends to go up, and index funds help you capture that growth without the need for constant buying and selling. For those who want to build wealth without trying to time the market or pick individual winners, index funds are the way to go. They're simple, cost-effective, and historically offer solid returns that can help you meet your long-term financial goals. 7. Real estate investment trusts, REITs. Let's talk about real estate investment trusts, REITs, a unique way to invest in commercial real estate without the hassle of being a landlord. REITs allow you to invest in large-scale commercial properties, such as malls, office buildings, and data centers, while receiving dividends based on a rental income from these properties. The best part is that REITs are liquid, meaning you can buy and sell them on major stock exchanges, unlike physical property, which requires a significant amount of capital and time to sell. REITs are legally required to pay out at least 90% of their taxable income as dividends, which makes them a great income-generating investment. They're also a good hedge against inflation because real estate generally appreciates over time, while rental income keeps pace with rising costs. For those looking for regular income or long-term growth, REITs offer a reliable option with a relatively low barrier to entry compared to direct real estate investments. 8. Intermediate-term corporate bonds. Lastly, let's look at intermediate-term corporate bonds. Bonds are loans you make to financially stable companies in exchange for interest payments, and while they are generally less volatile than stocks, they still offer better returns than government bonds in many cases. For those interested in generating steady income without taking excessive risks, corporate bonds offer a reliable choice. These bonds offer higher interest rates than government-backed bonds, while still maintaining relatively low default risk, especially if you're investing in highly rated companies. You can invest in these bonds through diversified bond ETFs, such as those offered by Vanguard or Fidelity, which provide access to a range of bonds, helping to spread out the risk. There you have it. 8 ways to grow your money without taking big risks. From high-yield savings accounts to bonds and REITs, these strategies offer a mix of security and growth, allowing you to build wealth without constantly worrying about market fluctuations. Whether you're looking for short-term stability or long-term growth, there's something here for everyone. The key is to stay consistent, diversify your investments, and focus on safe yet profitable opportunities. If you found this video helpful, make sure to like, share, and subscribe for more tips on growing your wealth safely and effectively. Let me know in the comments which strategy you plan to use to grow your money. Thanks for watching, and I'll see you in the next video.